What is good, Staggers University? I'm so excited to bring you a special interview I conducted with Lior Gantz of Wealth Research Group. If you don't know much about Lior, I find him to be one of the most insightful analysts I've seen on YouTube. Lior has this incredible ability to see the big picture, the macro lens of the world, as well as the economy, which then allows him to really pull things together in terms of trends, opportunities, and potential threats. In order to keep this video a reasonable length, I'm only giving you a few of the questions and answers that I believe give you the most relevant information right now.
So in the United States, we've obviously um, had a situation where after the reopening in 2021, there was a lot of inflation, and it was borderline hyperinflation, certainly in U.S. standards, and the Fed raised interest rates drastically, so drastically that it basically froze the real estate industry and any interest rate sensitive industry, but because of many things that are much bigger and more complicated and complex that the Fed cannot control. We still have inflation. So that's one thing. Inflation is still here. Secondly, because of many dramatic shifts in terms of the workplace, certainly because of mass retirement of baby boomers during the pandemic years and other demographic issues, we have a shortage of available workers, and that's driving up salaries. And of course, because we're reshoring, it started with the Trump years, and now it's continuing with the Biden years. We have a lot of new jobs that need to be people need to be trained for, and therefore salaries are going up. Unions are getting strong again, and that's keeping inflation with us. So between those two, the economy is doing it's doing well compared to how much credit choke has happened because of the Federal Reserve and high interest rates. And I think that the market is trying to understand whether or not, even though we've raised interest rates so much and frozen the housing industry, are we still able to grow through that and avoid a recession, basically what we call the soft landing scenario. And because the market is trying to understand whether or not that can work, we're seeing that the stock market is trying to process this, and we will actually know more in the next 2-3 months, because right now we've hit this peak interest rates consensus where the Fed is saying, hey, maybe one more, but then we want to keep it here. So that's called higher for longer, and we will see if the market agrees that higher for longer is not going to cause a recession. That's where we are with the U.S. economy. So basically, very tight labor market, very high inflation that's going to stick around with us, and very high interest rates that have created a freeze in the real estate world, and also dramatic losses for any holders of bonds, including the Federal Reserve itself that just reported colossal losses.
On your website, wealthresearchgroup.com, you share an almost 100-year chart of the ratio between real assets and financial assets. And it's very clear that we are at historic lows in the ratio. It would seem to me that the shift of deglobalization almost means a shift into real assets like oil, real estate, and commodities.
Because people have, finished college and then went into either banking or Silicon Valley or tech, or and nobody works in commodities anymore. Certainly not in the West. It's becoming really cheap. It's becoming real cheap, and I think it's changing. You can see, in my opinion, oil bottomed in April 2020 when the futures actually got to negative territory, where you literally needed to pay somebody to take barrels of oil from you because of the shortages in tankers and whatnot because of the pandemic. ExxonMobil reached 25-year lows in 2020. It's since has quadrupled in price and just hit an all-time high. Occidental, which is the company that Warren Buffett invested billions in, I think it's up around 600% since it bottomed a couple of years ago. And I don't think that oil prices are going down. You on one side you have a cartel-like environment with OPEC that can regulate the supply, and on the flip side, in America, you have a lot of political will not to engage in fossil fuels. So it's the perfect salad to create to keep high oil prices with us. Along with that, there's a real shortage in refineries, and that's the real problem. Because who wants to build a refinery when the president of the United States is against you? So we have a major shortage in refineries, and that will not change. That is here to stay, and that keeps the price of oil very high for years and years. So oil being a critical component of the U.S. economy, you guys burn 20 million barrels of oil a day. I don't think that's changing. It's obviously going to actually grow. I think that is going to drive real assets up. Oil is the mother of all real assets, and I think that is going to be important. Apart from that, because builders have not engaged in development of housing because of high interest rates, and because the entire generation of millennials paused marriages for 2 years during the pandemic, they're all getting married right now. They're all having children. They want to leave the apartments in the city because they just don't have to be there in the new work environment. They want to build their own homes and live in single family residences. I think that there's going to be a major boom in housing in the United States. There's a shortage of, I think, about 5 to 7 million homes, depending on what type of homes, etc. So between that and oil prices, those are the two main assets in this real assets category, and they're both going to be rising, while financial assets will probably be in some sort of a plateau. So the ratio is destined to go up to the real assets will outperform in this decade. This is a good decade for real assets.
This makes me believe what we've seen from gold and silver is just the beginning and not the end.
Gold has been an incredible performer under the fiat monetary system, having gone from 35 an ounce all the way up to 2,000 an ounce in the past 50 years. So saving in gold has been a very smart idea, no matter when. If you weren't, if you didn't start saving in gold in August of 2020, in most countries around the world, gold is already trading at all-time highs. It's at all-time highs in around 70 fiat currencies. It's not an all-time high in gold in US dollar terms, but the reason is because the US dollar is currently getting choked. The amount of credit that's disappearing from the system is unprecedented, with the Fed just literally extinguishing money from the supply. So I think that for the gold community, they need to really appreciate what's happening here in the 21st century. Gold has gone from 250 an ounce to almost 2,000. That's an eightfold move. That's better than the Nasdaq has performed in the 21st century thus far. So it's been a great 21st century for gold. It's been a great 50 years for gold. Silver, because it's de facto not a precious metals anymore, because it's been demonetized as money by central banks and governments. It's performing more erratically, more volatilely, but it's not performing as well as gold. Gold has compounded around 7% a year during the past 50 years, and silver has performed around 3.5%. So it's clearly an underperformer, and the best way to trade silver is to use it as a leverage trading vehicle when gold is hot. So I would say silver is more of a trading, while gold is best for saving long term, as a stacker, as you say. In the past 2-3 weeks here that we've done before we've done this interview, we're recording this on the 28th. There's a lot of downward pressure on gold because rates keep climbing into 13, 14, 15, 16-year highs, and inflation remains subdued. it's in CPI terms. So you're creating an environment where across the yield curve from 2 months to 30 years, you're getting positive yields. And if you're getting positive yields, what's the use of holding gold as an institution? If after inflation, you're getting real returns, there's no need for gold. Gold performs best when the trend is down. In other words, when real rates are plummeting, and they're doing the opposite right now. The silver lining in this, no pun intended, is that the real yields have climbed like a hockey stick in the last 3 years, basically since August of 2020. And so historically, when you look at in previous times where it's done something similar, once the trend reverses, there's a real bottom for gold, like a multi-year bottom for gold. So wherever this settles, I think that it will be a great opportunity if you're not fully invested already, to purchase gold equities, etc. Personally, if I can tell you, what I've done over the years is just developed the discipline of converting 2 years worth of my living expenses, or my family's living expenses this day and age, to precious metals physical form. So I just look at how much we spend on a monthly basis, and I multiplied it by 24. And so I have 24 months worth of living expenses converted into physical, mostly gold. And that, to me, if every person in the West does this, I don't think we need to worry about what the government does or what the deficit is, or anything else. You have 2 years worth of living expenses converted into precious metals. You can write your own ticket, and of course you can increase that. But to me, that is enough. If it falls below 5% of my entire net worth, then I raise it to 5%. That is essentially my position with regards to physical precious metals. And then on top of that, if I see opportunities in terms of oversold or overbought, etc., then I might be inclined to invest there.
Lior, on this channel, we talk a lot about investing in mining companies. When it comes to these stocks, what really matters, especially when it comes to risk and risk tolerance?
In the mining sector, the volatility and the boom and bust nature creates a situation where conventional stop losses and all these different types of risk mitigation, they don't work. What really works is knowing the people involved with the companies that you own. If you can really get to know management, it doesn't have to be on a daily basis or on a phone call basis, but just to understand the caliber of the people that you're investing in, that is the best risk mitigation. Because in mining, it's purely managerial skills that deliver results. At the end of the day, all mining companies sell the same product. So it's not the product that matters. It's the skills of the people building the value that matter. So to me, focusing on that is where you should focus your risk tolerance. You should only work or only invest in companies that are run by the most proven people. Anything else is just speculating that you found the next genius. Okay, so that's on risk tolerance. And I would say with risk tolerance that it's important not to overweight in mining. I have never in my life held more than 10% of my investment portfolio in commodities or mining. If you have a lot of time on hand, that's going to be your greatest advantage, because then you can really learn this business thoroughly in mining, and you will have an advantage that way, because then you can really start to learn about the top people, the top companies, the top regions, all the real important things. And of course, you can become more active as an investor in this sector. And I think that is going to give you the best edge, because sometimes it's about buying after huge dips. And the only way you can do that is if you really understand the company in a very big way. So time on hand is critical as well.
Lior, you've been so generous with your time and knowledge. How can my viewers follow you and learn more about your work?
Wealth Research Group is actually a free financial newsletter. You can subscribe, um, and we've been around for over 7 years. The idea of Wealth Research Group is to take something like what we just did, which is a 30-40 minute interview, but condense it into a 5 or 6 minute read 3 times a week, so Sunday, Tuesday, and Thursday. And I also talk about specific opportunities. In fact, my entire portfolio can be downloaded at wealthresearchgroup.com/portfolio. So it's kind of a marriage between macroeconomics, geopolitics, and the investment world.
I will definitely include a link in the description. Thank you again to our guest, Lior Gantz from wealthresearchgroup.com. Thank you again, Lior.